Hello friends, welcome to eNots MBA. Today we are going to start second chapter of Accounting for Managers, that is Basic Accounting Principles, the accounting concepts and accounting conventions. Why accounting principles are formulated? Are they really important to be followed? To get the answer of these questions, let us assume you have financial statement of two companies. Say, company ABC Limited and XYZ Limited. You would like to access their financial performance, compare, analyze, and decide to invest your money in the financially strong company. But these companies follows their own accounting procedures and methods. If there are no commonalities and no uniformity in the preparation of their financial statements, you will not be able to compare them. Will you be able to judge which company is performing better? Obviously not. So now you got why accounting principles are formulated. To bring these commonalities and uniformity, accounting principles are formulated. These principles are formulated and recognized by the regulatory bodies throughout the world. These principles are important to be followed by every organization to bring uniformity and consistency in the preparation of financial statements. What are accounting principles? Basic accounting principles are also known as GAAP, that is, Generally Accepted Accounting Principles. Accounting principles may be defined as those rules of action or conduct which are adopted by the accountants universally while recording the transactions. Focus on the words rules of action or conduct. Accounting principles are rules that are required to be followed by the accountants that governs the actions and conduct of accountants, which are adopted by the accountants universally while recording the transactions. According to AICPA, that is American Institute of Certified Public Accountants, accounting principle is defined as a general law or rule adopted or professed as a guide to action, a settled ground or basis of conduct or practice. Again, here also accounting principles are defined as law or rule as like other law and rule that govern our actions. Similarly, accounting rules and laws governs the actions of the accountants, that guides the action of the accountants, settle ground and provide basis of conduct and practice of the accountants in recording the accounting transactions in the books. Categories of accounting principles. Accounting principles are divided into two categories, that is, accounting concepts and accounting conventions. The term accounting concept refers to assumptions and conditions on which the accounting is based. Basic assumption of accounting can never be ignored. They are must to be followed by accountants while recording business transactions. Accounting conventions are the customs and traditions which guide in preparing accounting statements. We mostly use these conventions in preparing the final accounts as they are useful for better understanding. Accounting concepts. The first accounting concept is money measurement concept. According to this concept, accounting records only those transactions which are expressed in terms of money. Other transactions which are not expressed in terms of money, however they important are, they are not recorded in books of accounts. Let us understand this concept with some examples. For example, you are a manager in an organization. Your managerial skills, your knowledge, and your hard work is very useful to the business, but will it be recorded in the books of accounts? Not. Why? Because these traits or these skills are of qualitative in nature. And not in monetary terms. And according to money measurement concept, only monetary events and transactions are recorded in accounting. Let us take another example. If the assets are expressed like 1000 square meter of building, 2000 kilogram of raw material, or 10 machines, etc. Now, will these assets be recorded in the books of accounts? Again, answer is not. Why? Because these assets are expressed in quantitative terms. But not in monetary terms. So these assets are also not recorded in the books of accounts. Let us take one more example. If these assets are expressed like building of rupees 1 lakh, raw material of rupees 20,000, and machinery of rupees 10,000, and so on. Now, will these be recorded in the books of accounts? Yes. Because now these assets are expressed in terms of money and can be recorded in the books of accounts. So I believe now you got the money measurement concept. Moving to the next concept, that is business entity concept. This account concept is also called separate entity concept. According to this concept, business is considered as a separate entity separate entity distinct from the person who owns it. That is the owner of the business. The business and the owner are two different entities or two different personalities. The owner is different and the business is different. The amount invested by the owner at the time of commencement of the business is called capital. And capital is treated in accounting as liability, which is considered due to be returned to the owner in future. Let us understand this concept with an example. The owner of the business purchased a car for personal use. Will this car be considered as the property or asset of the business and recorded in the books of accounts? Not. Why? Because according to this concept, owner is different from the business and his personal belongings or personal properties will never be recorded or considered as the properties of the business and will not be recorded in the books of accounts. The third concept is dual aspect concept. This is the basic concept of accounting. According to this concept, no transaction is complete without double aspect, means to say that for every debit there is a corresponding credit. For example, Mr. Kumar started business with a capital of rupees 1 lakh. Now, this transaction will have one effect on the cash account and dual effect on capital account. Or we can say, now the business owns assets, that is cash, worth rupees 1 lakh, and at the same time the business has obligation to repay to Mr. Kumar rupees 1 lakh, that is in the form of capital. This can be represented in the form of equation as capital, that is owner equity, amounted to rupees 1 lakh is equals to assets in form of cash equals to 1 lakh. Let us take one more example. Now rupees 50,000 borrowed from Mr. Ram. This borrowing is done to further investment in business. Now this transaction will increase asset, that is cash, as well as liabilities in form of creditors, thus represented in form of equation as capital owner equity of rupees 1 lakh plus creditors of rupees 50,000 equals to assets in form of cash, that is amounted to rupees 1 lakh plus 50,000 equals to 1 lakh 50,000. So the dual aspect concept says that for every debit there is a corresponding credit. Next concept is going concern concept. According to this concept, it is assumed that business organization will continue to operate in the foreseeable future. And will not be liquidated or forced to discontinue operation. Okay, not be liquidated or forced to discontinue its operation for any reason. A going concern is expected to have the following things working in their favor. What things? The business is capable of running its daily operations and has sufficient capital and raw material to do so. Second, the business has ability to pay off its debts during the accounting period. Next, the service or product offered by the company is in demand in the market. Fourth, there should be no change in the law. To understand this concept, let us take an example. The accountant, while valuing the assets of the enterprise, does not take into account their current resale value. As there is no immediate expectation of selling the assets. Original cost of the assets is considered and depreciation is charged on the assets over the year for the life of the asset. This distribution of expenditure, that is depreciation, is possible only because of the going concern concept, which is the business shall be carried on for the least the life of the assets or beyond. I think going concern concept is clear now. Moving to the next concept, that is cost concept. Cost concept is of special significance only for fixed assets. Which are recorded in the books of accounts at cost, that is, at the price actually paid for acquiring the assets. The depreciation is deducted from the original value, which is the initial purchase price of the asset. Will highlight the book value of the asset at the end of the accounting period. The marketing value of the asset should not be taken into consideration. Now, the question is, why the assets are not recorded at the market value? The main reason is that the market value of the asset is subject to fluctuation due to demand and supply. The entry of market value of the asset will require the frequent update of information to the tune of changes in the market. Will it be possible to record the changes taken place in the market then and there? Obviously not. That's why assets are not recorded at the market value. Moving to the next concept, that is accounting period concept. As we already know, considering going concern concept, every business would exist for a longer duration. That longer duration is divided into appropriate segments of periods. Divided into segment of periods for studying the results shown by the business for each period. The specific period is normally 1 year. This time interval is called accounting period. This period can further be divided into 4 quarters, say quarter 1, quarter 2, quarter 3 and quarter 4 of 3 months each. At the end of each accounting year, profit and loss account and balance sheet are prepared. Profit and loss account shows the financial results, while balance sheet shows the financial position. Next concept is matching concept. One of the objectives of every business firm is to know its results for a given period of time. In order to know the profit and loss of the business, the cost incurred during a given period of time is matched against the revenue earned during that period. This helps to know the profit or loss. This helps to know the profit or loss of the business during a period of time. If the revenue exceeds the cost, it represents the profit. On the other hand, if the cost exceeds the revenue, it represents the loss. Next concept is realization concept. This concept deals with the point of time at which the revenue is taken as earned. According to this concept, revenue is realized when goods and services produced by a business are transferred to the customer. Irrespective of whether cash from the transaction has been received or not. Let us understand this concept with an example. For example, ABC Limited received an order in January. Organization delivered the goods in February and received payment in March. Now, according to realization concept, when the revenue is earned? Revenue is earned in February. That is when the transfer of goods took place. Accounting conventions are the customs and traditions followed by accountants as guidelines in preparing accounting statements. The first convention is Convention of Conservatism. Playing safe is the main idea underlying this convention. In the initial stages of accounting, not actual profits but even anticipated profits have been recorded. But the anticipated profit have not materialized. This has shaken the confidence in accounting. In consequence, accounting has started to follow the rule anticipate no profit and provide for all possible losses. For example, closing stock is valued at cost price or market price. Whichever is lower. The effect of the above is that in case market price comes down, then the anticipated loss is to be provided for. But if the market prices goes up, then the anticipated profits is to be ignored. When lower of the two is taken into account for valuation of closing stock, no anticipated profit is booked, but all possible loss is taken care of. Basically, the concept says that whenever there are two equal acceptable methods, the one which is more conservative will be accepted. When a judgment is based on general estimates, if there is a dilemma as to which is correct, the most conservative estimate will be accepted. When there is a probability of getting profit or loss, profit will be ignored, but loss will be taken into account. Second convention is Convention of Materiality. The materiality convention of accounting states that the business should include only the important or relevant facts in the financial statements. Material facts refers to any information which is excluded or misreported in the financial statement could influence the decision of the user of such financial statements. Thus, if excluding or misreporting certain information impacts the decision of the user of the financial statement, such information is material in nature. Likewise, if excluding or misreporting information does not influence does not influence the decisions of the user of such a statement, such information is not material or immaterial. For example, if information related to capital, stock, or sales is excluded or misreported, could influence the decision of users of such information, and this information is material in nature. On the other hand, information related to clubbing of pens, pencils, or stick notes, etc., under different head like stationery, is not of material nature. Therefore, items of material nature are recorded in detail separately under the respective heads. However, items that are immaterial in nature are clubbed together under different accounting heads. As in our example, pen, pencil, or stick notes are headed under stationery. The third convention is convention of disclosure. Convention of disclosure require that all material and relevant facts concerning financial statements should be fully disclosed. Full disclosure means that there should be full, fair, and adequate disclosure of accounting information. Adequate means sufficient set of information to be disclosed. Fair indicates an equitable treatment of users. Here, full refers to complete and detailed presentation of information. Thus, the convention of disclosure suggests that every financial statement should fully disclose all relevant informations. Next convention is convention of consistency. Convention of consistency implies that the basis followed in different accounting period should be same. It also signifies that the accounting practices and methods should remain consistent from one accounting year to another. For example, if a particular method of depreciation is adopted for a particular fixed asset, the same method should be followed. Same method should be followed for that assets year after year. Okay friends, that's all in this video. I hope you got the accounting principles, concepts and conventions. Thanks for watching. Please like this video and do subscribe our channel. Thank you.